Good morning, ladies and gentlemen. Well, we've had a very exciting week and the yield curve is doing what I thought it would do and is indicating the path forward. This week we have, as you know, we have the QRA, we have the FOMC, we have then all sorts of unemployment data concluding with NFP on Friday. I have included at the end of this video in the summary sheet a video that I did with Andy and also a document that I wrote for my subscribers about what I think is going on and why. You might think it prudent to go and see those first and read them before this video, because I don't believe that anything really that is going to come out next week is going to be as powerful over time as the yield curve signals that we are getting, and for the reasons that are explained in the document that I have linked at the end of this video. So you might think it better to go to the end of the video, download those documents, read them, view the video with the explanation, and then come back to this. And without further ado, I'll now tell you why I think the yield curve is disinverting, and that is the most powerful signal you can get. So let's go through the data that we're going to get this week in order. First of all, on Monday, we get the first part of the QRA, which is going to indicate that the deficit is rising and they need to fund more. I mean, that is no surprise. On Wednesday at 8:30, we get the composition of the funding supply, i.e. how many bills and how many coupons. The real surprise, the real joker in the pack would be if they decide to actually draw down the checking account. And that would be a real surprise, because that would mean that they would need to issue less of everything. That would be a political signal that they are trying very, very hard to goose the markets. I don't expect they will do that. That would be very strange, but it's a political year and anything can happen, so I want you to be aware of it. If they draw down the TGA, which is the checking account of the Treasury, that is a very powerful signal that they are trying to goose the markets hard. Again, they have said to us in the last QRA that they expect the coupon sizes to be held constant, and I quote, for the next several quarters. So really any surprise in coupon issuance, i.e. an increase, would be a deviation from what they said, and a sign that really the pressure on the deficit is getting unsustainable, and they don't think that they can just issue more bills to cover it, because that would take the bill issuance far, far outside of the 15 to 20% channel that they intend to keep it in. I don't expect that to happen. I think the QRA this quarter is going to be a complete non-event. But if it's not, it's a very, very powerful signal. The other thing they could do is change the language, i.e. take out this part where they say for the next several quarters, and they could indicate that they will start increasing issuance next quarter. That makes more sense to me, because that is after the election. So, that being a political year, that would make more sense to me. But in either case, both of these are steepeners. So if they change the language, it's moderate steepening. If they change the coupon issuance, it's violent steepening. And we got the steepening last week. This is 2s, 10s, as you can see. To me, this 16 area here is absolutely pivotal. We get one weekly close below and we're going all the way to minus 11, and that would mean that every single part of the yield curve will have disinverted from 2s out to 30s. So 2s 10s, 3s 10s, 3s 30s, 5 30s, 5 10s, everything, the whole yield curve from 2 years on out will have disinverted. Now, the real big one is 3 months, 10 years. 3 months, 10 years means that the Fed is now actively easing when that disinverts. That can only happen, or is most likely to happen, the probabilities, the odds are highest if the Fed sees a problem with the second mandate, and that is the unemployment mandate, which necessarily leads us to the odds of recession. If the odds of recession are rising, then the Fed will cut faster and quicker. I don't expect that to happen because there hasn't been a single piece of data which has shown that the Fed needs to accelerate its cuts or to think that the terminal rate is going to be anything but the terminal rate indicated by the market at the moment, which is around the 3.5% area. I've been saying for a long time that I don't think that this cutting cycle, unless we go into a deep recession, of which there are absolutely no signs now, will be very deep, simply because R star has undoubtedly risen and because inflation is sticky around that 2.5 to 3% area. The only thing that's going to knock inflation back to target or even lower is going to be a recession, and that would naturally require deeper cuts. But I think the odds of it happening next week or it being indicated by the QRA or the FOMC are very, very low. What would really goose the market and the yield curve is a low NFP. It is entirely possible that one of these months, and I'm not saying this coming week, but I'm saying at some stage the NFP really does show that the economy is weaker than we thought, and those odds are the ones that are driving the yield curve, in my opinion. All sorts of odds are rising. The odds of NFP being lower, the odds of recession, the odds of everything. I'm not saying that these things will happen. I'm saying that the odds are changing. And when odds change, volatility comes about, and that brings degrossing, as I wrote. And last week we certainly got degrossing, and the yield curve is driving it. If we now go below 16, I think we are going all the way to minus 11, and that's another, 30 basis points of steepening, and that would definitely indicate that there are some problems in the economy, that things are not well, and the bond market is anticipating them. So let's very quickly run through the yield curve. 2s 10s, steepening. Let's have a look at 2s 30s, steepening. Let's have a look at, 5s 30s, steepening. 5s 30s goes through this kind of level, it's going to minus 52 without a doubt. The important thing is that even the 200-day moving average is rolling over on all those charts. And, basically I think the steepening eventually is unavoidable. Whatever happens here, the retracements can be very, very small. And I've written all the levels in the summary sheet, so I won't go through them. But to me, this pattern is just one which is waiting to break down. So I think the odds are rising that we are getting a signal from the yield curve, which is very, very powerful, which is that at some stage we break down in everything and we probably go all the way back down here over time. And that can only be because the odds of recession rise and the Fed needs to cut a lot more than in anticipated. If we go and have a look at the individual tenors, you see that everywhere the 200-day moving average is rolling over. Twos are unlikely next week to go below 426. I just can't see any reason for it to happen unless the Fed does something really weird. I don't expect any kind of change from the Fed because it would be out of character and really pointless to waste political capital on something which is fully priced. The market has fully priced in a cut in September. So the real shock would be strong data, which puts September into doubt. I don't expect that to happen either. I think these markets are now pretty convinced that at some stage unemployment starts rolling over. Inflation is no longer the problem it used to be, and that is all discussed in the video I did with Andy, so I won't go over it again. But I just think that every single tenure is showing you the same thing. This is 5s, this is 10s, this is 30s. Now, the long end is showing far less inclination to roll over, and that makes sense because if the cutting cycle is going to be shallow, i.e. towards the 3.5%, well, where are twos going to be? Twos are going to be 375. Where are tens going to be? They're going to be around 4%. Where are 30s going to be? Well, they're going to be around the 420, 425, 430 area. So the long end has the least potential to go down, and the yield curve has most potential to steepen. And that is just the market playing the odds of what is going to happen next. A lot of people think that the bond market is forecasting a recession. No, it's not. It's just changing the odds of it happening over a foreseeable period of time. And when that happens, you get a steepening. Just a very quick word about 3-month 10-year. To me, 3 months to 10 years is the signal, and always has been. When that disinverts, you are in a heap of trouble, because that is immediate timing. As you can see, it's really not doing anything. In fact, it's been flattening for a while, which is normal because it is the signal that the immediacy is here. There is no immediacy at the moment, right? The Fed is telling you what the path forward is, i.e. September cut, and then very, very slow cuts towards a 3.5% about terminal rate. So 3 months has absolutely no reason to start moving now. It is moving very, very slightly. This is a 3-month. Basically, it's 9 basis points different than it has been for months and months and months. But when that starts breaking down, and we will be watching that over the course of the summer and early autumn, that is the signal of the immediacy. I would have thought that this first level here is going to be a very interesting one, because when that breaks, that means that this flag is breaking down, and then I think even this level around 57 is unlikely to hold, and I think this whole thing falls down to around here, which is minus 32. That's going to take probably 6 months, I don't know, something like that. But when that happens, the last part of the disinversion will have taken place, and that is a very powerful signal that the odds of recession are much higher than they are now. And that, to me, will be a risk-off event. Nothing to see here as yet, but we will be watching this very, very hard over the course of the next 3-4 months. Well, much the same thing is happening in Germany. This is twos, and they finally reached this 268, 269 level that I've been looking for a long time. They made me suffer. It's all poised. It's all getting to support and sitting on support, fives, tens, everything. And the yield curve is steepening. This is twos, fives. This is twos, tens. Much the same picture as in the US, right? But with a lot less impulsion. And I do believe that all these markets eventually will break down and the yield curve will signal an increased odds of recession. To me, it's just a question of when the steepening happens. I think the steepening will be much more pronounced in the US than in Europe, but the steepening it is. So every time the twos come back to something like 280, 282, you're supposed to buy some shats and see what happens. I think the odds of these markets now going above 294 or sorry, that's 299 are almost zero. You can never say it's zero odds, but I think it's very unlikely that we retest anywhere near those highs. And I think this 200-day moving average is going to basically be the top bound of what yields achieve over the course of next several weeks. To me, this is all going to break lower eventually after some consolidation, and the yield curve will actually lead it. We do have CPI in Europe next week, and I'm showing you this chart of the Bund against the Oats because I think that if CPI is somehow a surprise higher, that they are going to hit the 08Ts much harder than the Bunds. I think that they will definitely try to go for this 78 level again in the Bund Oat. So if CPI is somehow a surprise higher, which I don't really expect, I think the first reaction is to sell oats as opposed to Bunds. And the other chart that I showed you last week, which is the butterfly with the gilts in the middle and the US and Germany on the wings, is slowly beginning to turn. And I think any weekly close above 165, 166 is going to give you something like these levels, 202, 203. I don't expect that to happen immediately. I am looking for something bad to happen to gilts just before or just after the autumn statement. So we have time there yet. I mean, it could very well be that this is the top and it reverses. I have no idea. But I think that the odds increase the closer we get to the autumn statement that there will be an accident in gilts again. So my favorite way to play this is still this butterfly, and I think that we need to watch this level, and when it starts going through, I think we can easily make something like 15 to 20 basis points in a hurry. Germany versus the US is trading technically very well indeed. 182 is the top, and that is the reason why I think that the DXY, the dollar, eventually will break down. You get to do a few more weeks of this kind of behavior, turn the 200-day moving average, and then really bust through 172. That would be the reason why the dollar would break lower. It's not happening at the moment. I don't think it's going to happen for, several weeks here, but eventually I do see this pattern breaking down and us going to this kind of 152 area, which to me would mean that the dollar loses 2, 3, 4% of its value. Currencies are getting interesting again, and this is a daily dollar-yen chart. All we've done is come back to the 200-day moving average and slightly bounced off it, with very, very oversold levels. So what are we likely to do? We are likely to go back up to this kind of level, 156, something like that. Now, I can even enlarge this so you can see it better. I don't believe that we had any kind of signal from dollar yen last week. All it was degrossing, and when degrossing takes place, you get rid of the funding currency because you no longer need it. Everyone was funding positions in yen. They got out of the positions, they got out of the yen. So this was cause rather than effect. I mean, rather the other way around. This was effect rather than cause. The dollar yen is really doing nothing, and I believe that over the course of the next several days it's going to trade this 156, 157 area again. But let's have a look actually at euro yen. Euro yen has not turned its trend. It's got the same pattern. It's going to go back up towards 168, 170, and then it might do another leg lower, but still it just keeps on bouncing off the 200-day moving average. These are all corrections rather than anything fundamental. So that actually tells me that the degrossing that is possible is not going to be that huge next week, but that's just a guess. What does that mean for DXY? Not a lot, because unless we start seeing the differential in the 10s, Germany, US move out much more than 182, which I don't expect, and the DXY we all know is 65% euro, it's likely to remain in a range. 104.80 is the kind, 104.80, 104.90 is the level that I want to sell and add to my shorts, and then I think that we come back down towards this 104 level. I don't think that we're going to see a massive move in the dollar next week, simply because that would coincide with a sideways move in the 10s, bounded between 172 and 185, something like that, and that does not allow for a big move in the Dixie. But eventually I believed, just as the 10s are going to break 172 to the downside, I believe that this is going to break the 104 to the downside and trade somewhere down here around 102. But that, I believe, is going to take some time. It's nothing that I think is imminent. And next week is all going to be dictated by the bonds in any case. And the Dixie, all it will do is trade 1-for-1 with what the yield curve is doing and what the differentials are doing. Gold at the moment, I think, is as stuck as the long end of the bonds are. I really don't see why gold should outperform real rates at the moment. And since inflation is moderating, I'd much rather get 2% over CPI than get 0 over CPI. I don't see what the urgency to buy gold is. So at the moment, I think that we're stuck in this 2310 to 2450 range. I think depending on what the QRA and what the FOMC does, and especially what NFP is, that gold is stuck. Now, why would I want to buy gold, and when would I want to buy gold, rather? I would want to buy gold if the Fed does something silly. Now, I don't expect it, and therefore I don't expect that I'll need to buy gold. But should the Fed start panicking here and cutting prematurely, that would definitely mean a big steepening, as I said earlier, and I think in that case gold is going to be sought after. I think people are going to think all sorts of bad things are coming and they're going to be buying gold. that's the only scenario that I can see that gold is attractive, and that is if people think that the Fed is abandoning its mandate. I don't expect it, and therefore I don't expect to need to buy gold anytime soon. This is naturally DBC, and the real problem here is that it's really doing nothing, but that it's looking quite weak. I think this 2175 area is absolutely key. If we start breaking it, then there's something going on, and that actually tells you that it's an increase in recession probabilities as well. I don't expect it to be imminent, but I'm watching it like a hawk. Breaking 2175 and staying below 2175 is an indicator that we are really increasing the odds of recession. If we have a look at oil, the reason why I don't expect anything much to move in DBC next week is that we have support from the 200 period moving average and from this 75.16 level, and we are not breaking it, we're just going sideways. But a market which goes sideways tells me that inflation is not going to reaccelerate, and that is good for the bond curve as a whole. So that is why I think real yields and real tips make a lot of sense here, and you should be buying those instead of gold and commodities right now. Before we look at the individual indices, let's have a word about risk in general. This is the totality of the stock market against the totality of the bond market, and this is still a very positive chart which tells you to prefer equities to bonds. Now, we've had a little correction. Little corrections are absolutely normal. We had a little correction here, we had a correction of over 3 months here, and nothing really happened, right? We had no recession. There is no way that I want you to get the impression that I think a recession is around the corner. I am talking about the odds of a recession. While they were very, very low, they moved a little bit higher, and that caused the volatility, which caused the degrossing, and we got this. Now, this is really nothing, and we are very, very well positioned for a bit of a bounce next week, should there be no surprises in anything. I think if next week the NFP is just fine, and odds are that it could easily be, and if there is no surprise in the QRA and the issuance is exactly what we expect, and the Fed has no surprises and it tells us go back to sleep for 3 months, boys, or until September, the odds are that we get a little bit of a bounce in this rather than anything else, because bonds will be stuck, absolutely stuck. They can't do very much to the downside. They have no reason to do very much to the upside. And then what happens? Well, people pile back into risk, right? And that's equities, and we get a bounce towards these levels. So what I'm trying to tell you is that we've really had no signal whatsoever that recession is coming. All we had was degrossing, because the odds of it went from, 2% to 4%. But a doubling of the odds of recession does not mean we're going to get one. It just means that the odds changed. RTY over NDX. And that is really all that happened last week. The degrossing means that you sell what you have. A lot of people were very, very long MAG4, and a lot of people were very, very short Russell stocks against it. So they got out of the position and caused this, almost 3-week move. This is a weekly chart. But look where it comes from, okay? This is a secular trend. There will be periods like, 2020 and then 2022 when this reverses slightly and goes back to the 200 period moving average. And this could very well be one of those. But the trend, NDX over Russell, is a huge trend down. Okay, there's absolutely no doubt about that. Human ingenuity and new technologies are going to be far more powerful than we can possibly imagine now, and certainly more powerful than 2,000 stocks, half of which are complete zombies and are going to blow up for sure and be worth absolutely zero, to be replaced by another 1,000 stocks which aren't going to make it. So to me, there is absolutely no doubt about the long-term trend of this. Now, can it last another week or so? For sure, okay? For sure can come up to here. So that's a big move, actually. That would be another 5-6%. But I don't believe that this is anything to be worried about. These are normal things that happen during normal degrossing. This is absolutely nothing out of the ordinary that's happening at the moment. So let's have a look at what the market did last week. Google earnings, degrossing, yen, etc., forced it to the level that I thought was really important, 54.47, and then we just traded around that level. Closed slightly above it on the week. I don't think that really makes very much difference, but what does make a difference is that we didn't even manage to fill this gap, which to me was a bit odd. So now we have two-way potential. I think next week we will definitely bounce and try and close this gap a little bit to around this kind of level, 55.25. But I think it's very, very unlikely that there aren't a lot of sellers up there, because there are still people trapped. And if the earnings from Apple and Amazon and etc., only beat by a little bit, those people will want to get out and the degrossing might not be over. In any case, I think that the odds of us closing next week, unless we get a surprise from the QRA, and we'll know that immediately, and unless we get a surprise from the FOMC, and we'll know that immediately, and these are very low odd probabilities, and then unless NFP is weak, but again, it's it will probably be explained away by Hurricane Beryl and all this. The odds of us closing below 53.72 to me are not good. I think that any move up will be sold by the people who are still long and need to degross. But I don't think that we are changing the trend in equities. We are still looking for places to buy, and my first place to buy now is this 53.72, followed by 53.27. This kind of area, I think, is a buy area for a decent sized bounce. I think the NDX is at far more risk of lower prices than is the SPY. And that is because, as I explained to you, unless the MAG4 earnings that we get next week are very, very good, the odds are that there are still people who need to sell. So any kind of reaction up to these kind of levels, 19.5, 19.6, is likely to get sold by those people, and then we see what happens. But certainly if we start getting below the 18,200 area, then we're in trouble. I do not expect that. I think the 18,875 that I talked about held, right, on closing basis, and therefore the odds of us not bouncing from somewhere around 8,200 are low. I think the odds of us going and visiting it might be good if the earnings are not as stellar as some people might hope. I think there's going to be a lot more volatility in the NDX than there is going to be in other equities, but I think it'll hold. I think there are good levels down here that you should buy. Vol as well is not showing any abnormalities. Okay, this is completely normal behavior in Vol. Gets to the top of the Bollinger Bands, backs off. We actually closed this week lower in volatility than we did last week. So I really don't see that we are in anything but a run-of-the-mill degrossing, and that's that. Which tells me that the yield curve is not going to do that much next week. It's not going to give the signals that we are in imminent danger of the odds of recession going even higher. It's just going to be a continuation of people's positions being flattened out, bad positions in the spread between MAG4, i.e. NDX, and other stocks in the Russells that they were short of being squeezed out. And once that is over, the market can calm down. And when the market calms down, the risk on can basically come back, and we start going back up slowly in the indices. It might take a while. It might be volatile next week because anything could be a surprise in the data or the news that we get. But I think overall, we are going to stabilize next week. One chart that I find interesting is this one, the Nikkei. As I told you earlier, I think the degrossing had a lot to do with what happened to the yen, and therefore what happened to the yen had a lot to do with the Nikkei. And I think that we are somewhere near the bottom here. I think buying the Nikkei next week is actually going to be one of the more interesting trades. You can have a stop below this kind of level, 36,750. If it goes through there, odds are that it goes further. But I think that the Nikkei can easily come back to 39,500 next week. And that is what I'm looking for. Stocks absolutely refuses to close below 49.50. Absolutely refuses. And that to me is another powerful signal that this is not risk off. If it were, this level would get busted, and every time we bust it, there are big buyers and we close back above it. This is just, to me, is just a consolidation period, and the next move is still higher in European equities. That is why I can't get very bearish of the equity market overall, and everything is telling me that we're going to get some stabilization next week, and then we buy it again. So what will I be looking for most next week? I've changed all the levels. Naturally, I think the yield curve is going to give us a signal. I don't expect it to be next week. If it starts closing the week below this 16 level, obviously I'm wrong, and there's a lot more degrossing to come, and you have to respect that. I don't expect it, as I said. In any case, I've changed all the levels, and here is the link to the video that Andy and I did for Two Great Beards, and here is the document that I wrote about the degrossing. I really don't expect that much to happen next week because everyone is expecting a lot to happen next week. I think the QRA is going to be in line. If it's not, it's a very powerful signal and we can act on it immediately. I expect the FOMC to tell you that nothing is happening and to retain optionality, and therefore what's the market going to do on that? It's really as expected. And then it's all in the hands of NFP and the other employment indicators, which are the ones that could really throw a monkey wrench into everything. But who knows what those will be, and we can react to them when they happen, and that's all that one can do. Thank you very much indeed, and tweet you tomorrow.